Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Well, hello, and welcome once again to another radio edition, soon to become a podcast edition of Talking Real Money, the program that is specifically designed, it was created and designed to make you the best possible manager of your money you can be, the best possible investor you can be, without any gadgetry or gimmickry or special magic tricks that so many others claim to be able to perform. We don't do that. We're here to help you. Our phone number is 855-935-TALK, 855-935-8255. And we know that despite the fact that you are incredibly well-trained, those of you who are regular listeners, many of you are not. And in a situation like that which is occurring in Europe, a lot of people are scared. I've gotten a call from my daughter. My wife has said, and she knows better, she said, should we move some money around? And I know a lot of you are thinking that. And we're here to help. Call us at 855-935-TALK.
And, you know, it was a wild couple of days that might have made your anxiety go up greater, right? I mean, we had a huge downturn in stock prices on Thursday, Friday, right back up. So a lot of volatility there, again, that makes people think, as you said, Don, I got to move money around. But here are the things we actually know when we talk about investing and conflicts and war and these awful things.
I want to reiterate what Tom is saying. Here are the things we know for a fact.
Again, and this is the long term. Anything in the short term, we have no idea. We don't know what's going to happen next week, next month, next year. But what we do know is, of course, the human and social costs of war, it's just horrible, right? I mean, Don and I studied a lot about wars, and my dad was in a war. I mean, it is awful. So we know that, right? There's no question. But from a financial standpoint, the geopolitical events that tend to really get your attention, in the long haul, not that much impact on your investments. Again, in the long haul, whatever is going on in the world, markets are going to go up and down. They may go down more for the next period of time because markets hate uncertainty, but over time they have recovered and done all right. And so we still believe the same as we always have: disciplined approach, diversified approach, low cost, and you got to figure out how to sort of tune out a lot of the noise because there's going to be a lot more.
We all want to do something. It is human nature to want to react, to find a solution, because how does this affect me? What can I do to protect myself? Well, the fact of the matter is, and Jason Zweig talked about this today in his column in the Wall Street Journal, the time to have planned for events like this, events that occur, we don't know when they're going to occur, but we do know bad things happen to human beings and to our species all the time. The time to plan for it is not after it has happened. It is well in advance of any bad news.
And your portfolio, again, to reflect that, Don, should be ready for those ups and those, how much you're trying to make, how much volatility you're willing to accept, so that you're not forced into. We do know one other thing. People that make emotional decisions, anything in your life generally about emotion, it's not a good decision when it comes to your money, can be truly awful. Because I did talk to a few people last week that on Thursday and Friday that wanted to move out of stocks into cash. Again, after the market had gone down dramatically, people felt more comfortable, I guess, on Friday after it went back up. But if you're feeling that way, that's where you either need help or you need to look at your plan and say, this is part of the process, the ups and downs that have made me more money.
Now, I want you to think about this for just a minute. For example, if most stockbrokers, they're going to do whatever you tell them to do. Sell me out. Sell me out. Okay, we'll sell you out because they know they can buy you back in and make another commission later. A good advisor will tell you not to do that for exactly what happened. If you had sold your shares on your ETFs or whatever it was on Thursday near the market close or on Friday just as the market was opening, you would have made a loss real and then missed the recovery that occurred later in the day. The market opened way down on Friday. And then money started coming in going, well, I'm going to buy this stuff cheaper. They're taking advantage of the panic to make money. And they're going to take advantage of your emotions to make money. The smart people are buying when things are bad, and they're selling when things are good, which is just the basic philosophy we talk about. It's buy low and sell high. Don't buy high and then sell when things look bad. Give us a call. 855-935-TALK is our phone number. I'm Don. That's Tom. Hanging out here talking real money.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
We want to help you manage money better. And to do that, our favorite thing to do is to answer your questions. And you can call them in. You can send them to us. You can call us right now, though, live as we do the show on Saturday from 3 to 5 Eastern, noon to 2 Pacific in the Seattle, Washington area at 855-935-TALK. Henry, you are next. Welcome to Talking Real Money. You're first, actually. You're not next.
Gentlemen.
Henry.
Yes, thank you very much. It's so great to be here. Hey, that first segment was so serious. I seriously considered not staying on the line.
We're only laughing, Henry, because after the segment, I told Don, I don't think we've ever done a segment like that before. So thank you. We'll take that as a compliment.
No, he hated it.
Right on the nose, but okay, Don.
Yes.
Your Wordle problem. What my daughter does is when she finds that there's a word with a whole bunch of one letter difference, she constructs a word out of those letters to help her eliminate.
Well,
does that make sense?
Yeah, I did that this morning, and it was like it was words that it was an S and a blank and I-N-E, and it was like, there's so many of them. Or
W.
It was really
right. So she constructs a word from all the letters that it could be.
Yeah.
Just some random word.
Oh, I see.
But Wordle kicks out. It has to be a real word. Yeah, you can't just fake words. They're very particular. But thank you for your help on that. Because Wordle is so important to my functioning as a human being.
Thank you for lightening things up.
Yeah, go ahead. What else have you got? Now give something to Tom. He needs help.
Have you heard of this? Okay, have you heard of this guy, this Paul Merriman?
No.
I
think we knew him once back in the 80s or something.
I'd like to talk real money.
Is he still alive?
Yeah, I don't have real money.
Yeah.
But I have a little bit of money.
Yeah.
And so, what he has these different portfolios, and you can get one with like 14 different ETFs in it.
From Paul Merriman?
Is it up to 14?
14.
Wait till Friday; it'll be 20. So,
well, if you put bonds in it too, see, you got to have some bonds in there.
Okay.
Well, I don't know. Maybe that's I thought. And the thing is,
we think that may be a little bit overkill for most people.
Of course it is, but it's fun. It's just pure fun. Because I sat down and I made this little Excel thing that tells me how far each one is out of whack from what it should be. Because, it's all done in by percentages, right? This fund or this ETF is 6% and this ETF is 10%. And so my question is rebalancing. You can rebalance by time, but I like the idea of rebalancing by when things get out of whack. So my question is how far out of whack should you let something get before you sell the winners and buy the losers?
Okay, here's how I would do it. I figure it's pretty simple, even though with 16 funds, I didn't realize he'd gone that And yes, we know Paul. Paul is a friend. He's speaking at Retire Meet in a couple of months, so he remains a friend. He remains a friend. And we like his work, and we like his website, etc. And I'm with Don. For most people, 14, 16, however many funds, it's a lot of work. But here's the thing. Here's the way I would do it, Henry. I would simply have whatever my stock to bond ratio is. Let's just say for argument, it's 60% in stocks, 40% in bonds. As soon as the stock or bond, something gets out of whack between that ratio, in that ratio of more than 5%. So for example, the stocks go to 65% and the bonds are only 35. Then I would look at the underlying assets in each one to decide what to sell and what to buy. But I would only do the stock to bond because if you start doing every fund that way, you'll be spending a lot of time buying and selling stuff and more time, it won't help what you're really trying to do. And most rebalancing should be about protecting assets, not necessarily making more.
Yeah. Wow. It is 14.
Wow.
I'm looking at his portfolio at 14. Wow. Overkill, Paul. That's a lot. 855-935-TALK is our phone number, 855-935-8255. Yeah, I'm looking at 14 funds.
Wow.
Hey, Steve, you're up next. Welcome to Talking Real Money.
Gentlemen, I'd like to find out which one of you guys went to Stanford and one of you guys, which one went to Harvard.
I was at MIT myself. I don't know where Don went, but
I went to, what was that school in Grenada?
Yeah, the medical school of the Caribbean or whatever it is. That's funny. Thanks, Steve.
All right.
But do you have a question?
I'll get down to the nitty-gritty.
Yes, sir.
I've got 4 funds here, and instead of, like a lot of people, they get a whole bunch of funds, just like you said, 14 funds, 14 mutual funds. That's way ridiculous. I think it's way too many. I've got 4 here, and I want your evaluation of each one of those. Here they are, rather than someone, buying small cap, mid cap, large cap, everything like that.
Go ahead.
Total stock market index, VTSAX.
Yeah, we know that one.
4%.
Mm-hmm.
Vanguard 500 index, VFAIAX, 04 cost. Vanguard Total International Index, Admiral, cost 011 VTIAX. The last one. Vanguard Total World Stock Market Admiral World. It costs 0.10 VDWAX. Should someone buy all 4 of those?
No.
Or do you just need 3 or
2?
2's enough?
You only need 2. You got a lot of overlap.
Well, actually, 1.
Yeah, you could just do the total world.
You could just do the total world and have
take 14 funds and put it into one.
Your fund, what you have there are the exact same assets in the other.
Well, it owns
funds
those because the world is a fund of funds anyway.
Yeah. Yeah, the only thing I would probably have the VTSAX and the VTIAX if I wanted to build just with those 2 funds the proper U.S. international, because the Vanguard Total World is overweighted to the U.S. slightly.
And if I was starting today, I would just own VT or VTI, because then you just got one exchange traded fund that owns the whole thing.
VT is exactly the same.
Yeah.
It is exactly the same.
At a lower cost.
But at a lower cost.
More tax efficiency. Yeah. So I would just, Steve, I would just have, again, if you want simplicity, if you want a little more complexity, and Don correctly points out, if you don't want to overweight to the U.S. and you want to set your own U.S. to international exposure, you could own the total U.S. and total international. Then you can set, and by the way, this might be a good time to buy international stocks. We'll talk about that in a couple of minutes, but for surprising reasons.
Timing. Wait a minute. Are you timing
it sounds
the
like
market?
It, doesn't it? Sounds like it. But no. So, but again, yes, in the portfolio you just mentioned, you have a lot of overlap in those particular funds.
You need at most 2 and at least 1. And the 500 shouldn't even be there. Thank you so much for your call. Our number is 855-935-TALK.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Welcome back. I'm Don, Tom over there, talking money with you out there. And you can call us right here at 855-935-TALK if you're listening to us on a Saturday. If you're listening to us on Monday or Tuesday or Wednesday or Thursday or Friday, well, you can call, but we're going to answer your questions on future podcasts. Do you have anything you want to add to that?
We got to lighten it up a little more. I mean, you could tell somebody was like, what was that first segment? That was
Henry was going, you're too serious,
yeah,
guys.
you guys freaking me out.
Hey, there's a war on.
Yeah, it's no time for comedy. Let's talk about the globe a little bit in terms of investing, because as you know, we tell people be globally diversified.
And we've caught a lot of crud for that over the past few years.
Yeah.
As the S&P 500 has been the place to be.
Now,
and, if those international stocks aren't doing very well, Don and Tom.
Yeah, and you would think in a year like this, where Russia is an emerging market, right?
China is an emerging market.
Ukraine's
Ukraine's an emerging market.
I don't think we own Ukraine, but anyway, I'd be surprised. But we do own Russia. Now we own a little tiny bit when you look at your whole. We'll talk about the number in a minute. But here, if you were a betting man, and I know you're not, Don, but others in the audience might be. If you were, would you believe that the Standard & Poor's 500 or emerging markets, Brazil, Russia, India, China, the riskier countries, which one would you have thought would do better during this global chaos we're in right now for 2022?
Well, one would think that the big blue chip stocks would be the ones, the S&P 500. One would be wrong, but one would think.
Yeah, I wish I had my buzzer, because the S&P 500 has lost 7.8% year to date, almost 8%. Conversely, emerging markets are down 1.3, or if you own emerging markets value, as I like to say, crummy countries and risky countries, you've made 1.4%. What? How could that possibly be? And a lot of people were talking to me Friday like, I don't want to own emerging markets anymore because I'm exposed to Russia. How much Russia do I own, Don?
Well, what's interesting is in a regular portfolio, if you just had the index, you would own about 5%. About 5% of your portfolio
Not of your whole,
would be in Russia.
No, 5%
of your
the emerging markets, which should only make up 10% of your overall.
Right. So 4% of the 10%.
Yeah, there you go.
But I, for example, use Dimensional's ETF for my emerging markets, which is DFAE.
Yep, DFAE.
I use that. That's in my portfolio. It has 0.72% in Russia.
0.75%
of the 10%. And what's really interesting is I went down the list of small countries, and they have a governance clause. There has to, the country they invest in has to have reasonably decent governance. And I'm going down the list, and while the index would put money in places like Lithuania or Latvia, the fund does not. And Ukraine isn't even on the list. So, you're not going to have any Ukrainian stocks.
I was just trying to find how much that costs, that fund.
Oh, it's cheap. Hold on, I got it right here.
Locate it.
It's 0.35 for an emerging markets fund. That's very
day. I remember in the days we used to pay 80 basis points for that or more.
Because it was expensive to buy those stocks. But in the emerging markets fund, the top nation holding is, of course, China.
No surprise.
Of course, China. Yeah. Followed by Taiwan, India, South Korea, Brazil, South America, Thailand, Mexico, and Indonesia. So they are pretty stable emerging markets economies.
I still love that expression. Because people forget that 150 years ago we were an emerging market.
Well, yeah, but that was 150 years ago.
Okay, but at the time, because whoever was doing this show, was doing this show on the radio and doing the podcast, they were saying the same thing. You don't own the United States. That's a risky place.
Nobody except us reads history.
That's a good point. Well, that's not true because all these books behind me would have been, wouldn't have been published.
The number of people, the percentage of the population of the world who study history at all is tiny. True. It is almost non-existent because nobody cares. I care, you care, we care. That's why you'll learn a lot more here because we care. 855-935-TALK is our phone number. call us because we want to help. We do. We really do.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at vestory.com, vestory.com.
Reality radio for a really great future. We're talking real money.
855-935-8255. That spells talk. I'm Don. That's Tom. We talk real money. And as this is a live show when we're recording it, as most things we do at any given time, we do actually live. We can't pre-record our pre-recording. I'm pretty sure, I was told anyway, that Cindy is up next. I'm hoping that Cindy is actually there, or I'm going to look like a fool. Cindy, welcome to Talking Real Money. Cindy is there.
I'm here. You're not going to believe. I've been listening, waiting my turn, and I'm scratching some lottery scratch-off.
Oh, great investment. Wow.
So now you do realize that by law the fact that we're on the phone with you at the time you're scratching off, we are entitled to a third of the win. Don gets a third, I get a third, and you get a third. So it's the law. We didn't write the law.
You love his math?
That's the way it
Don't
is.
you love his math? He was not a math major.
Okay, so my birthday was 2/22/22. I turned 65, and so all my relatives are like, "You need to go buy some lottery tickets." So I bought these scratch-offs, and
you're going to do them live on the show?
This is big for us. You're going to do live scratch-offs on the show. You're
going to do it live on the show?
Major moment. Drum roll,
legal?
please.
No.
Oh,
I've just been doing like a few a day, but I did win $100 on one ticket, so that was like, wow.
Tom, that's $33 a piece. Wait, no, it wasn't during the show.
33.34, 33.33. Yeah, you get 33.33. I get 33.34. So fair enough.
All right, what's
Happy
up?
birthday.
What's up other than the lottery and happy birthday?
Medicare.
Okay, thank you. So my husband and I are both 65 now, and he's still working. And we have everything in Vanguard, but we did buy 40,000 in I-bonds. That's not in Vanguard. So we had about 1.4 in our portfolio on January 1st. Now we don't have that anymore, as you can imagine. We did some reallocating, or whatever you want to call that, December of 2020.
Okay.
Because we were too invested in stocks and we were getting old. So my husband says we need to buy all these bonds. Well, okay, so we got all these bonds, and we have a lot of our Vanguard stuff in IRAs, mostly Roth, a few traditional. And then the bonds went down, 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 and I got really upset with him. And he's managed all of this for like 40 years, and he's done a remarkable job. But I got upset, and I said, I don't want these bonds anymore. So I put it in just a money market IRA, just to let it sit there. A couple $100,000 was just sitting there. Well, he got really upset with me when he found out that I did that. So then I said, okay, pick me some bonds. So on January 1st, he did his bond homework, and he picked these inflation bonds because he said, well, I did my homework, and there's inflation. And on my $175,000, I lost like $7,000 in 30 days. And I said, I'm out of here. These bonds are supposed to be safer, risk one. And why am I losing like $7,000 in 30 days on these bonds? So I don't know what to do. He got mad at me because I sold that again. And now it's just, there's $175,000 sitting in the money market account that I don't know what to do with, because I contacted Vanguard, and they don't do that personal portfolio help anymore. They quit doing that a couple years ago.
Okay.
We
need to talk.
Them,
we
they don't.
Cindy, we need to talk.
Yeah.
You are not the first person who's called us with this. I'm sorry to tell you. Nobody likes losing money. Nobody likes seeing the value of any part of their portfolio go down. But we need to have a little lesson on bonds. There is no way that a high-quality, short to intermediate term bond portfolio there's no way it can ever lose half its value. No way, no how, can't happen. Your stock portfolio, though, could lose 50% of its value. Has in the past lost 50% of its value. That's what we're talking about. We're talking about relative stability. If you want securities that never, ever, 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 ever go down, you have to accept a return of zero. Actually, right now you have to accept a return of negative 6%. An automatic guaranteed negative 6% because of inflation. Hang on a minute. I want to talk more about this. It's important.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Before the break, we have been talking with Cindy, and Cindy's husband made a decision to properly, probably, diversify their portfolio into some additional bonds as they're in their 60s, their mid-60s now, for safety, for additional stability. He was, in our opinion, acting rationally. Cindy, you're acting emotionally. You're letting emotions determine your decisions because while you may want it, there is no such thing as an investment with a positive return that has no risk. Not today.
And you mentioned the bonds being down. Yes, bonds are down, 2-3% year to date. Don mentioned that at any time stocks could fall 50%. As recently as March of 2020, they were down 35%. Here's my suggestion. Because you're prime candidates. One is retired. The other one's moving closer to retirement. You need a plan that says, here's what we're trying to accomplish. Here's how much money we're trying to make with our money. Here's how much volatility we're willing to accept to do this. And here's when we need to start drawing on the portfolio. Because once you have that in place, bond prices, invasions, inflation, all of that stuff comes along, but it doesn't impact your portfolio and how you're positioned, because that is preset, and it does. All the rest of the stuff comes along and doesn't matter from there.
Once you've had a plan and you build a portfolio for that plan, the other thing you need to make sure, and this is for everybody, John Bogle said it, the late John Bogle said it over and over and over again, when you have the right portfolio constructed for your purposes, don't peek. Don't look at it. Stop looking. If you want to look once a quarter, maybe.
It's
once
like
every 6 months.
Me and the scale. Stop looking.
Don't look. 855-935-TALK is our phone number, 855-935-8255. And Rita, it's your turn. Welcome to Talking Real Money.
Thank you very much. I'm a new person to the stock market. I called you guys a couple of months ago saying that my brother was telling me to get into penny stocks. I know you said not to do that. So now my question to you is that my husband and I both have Roth IRAs with U.S. Bank. We also have one mutual fund. And so I recently took $10,000 from our savings account because that earned zero, and I moved it to our mutual fund. And then our investment person with U.S. Bank sent me an email saying, well, you could move your $10,000 into the American Funds Balance Fund. And I did ask him about that after listening to your show about Vanguard. And he says, well, Vanguard has cheaper fees, but you get what you pay for.
That's not true.
No, that's true. You do get what you pay for.
What?
You get to keep more of your own money. They don't take it. That is very true. I completely agree with him in this case.
All right. So he sent me 3 choices that I can move that $10,000 to, but they're all in American funds. So now I'm wondering in our Roth and our mutual if I should get out of American funds and go to Vanguard.
Yes. You see how
let's
long
talk
it took
about
me
the
to...
key. Let's talk about the key differences. Yes. Number one, the American funds that your banker is very kindly going to sell you is going to include a commission of some kind. It could range up to 5.75%. Number two, the fund that he's going to move you into, likely, Don can look this up, the American Balance Fund, I'll bet it costs 50, 60, 70 basis points a year. Conversely, you can own something at Vanguard. You can own the Vanguard Balance Fund for probably 10 basis points a year.
Yeah.
Let me finish just very quickly, because here's what else we know. We know that people that actively manage money at American funds they do not end up outperforming the market. They end up underperforming for the aforementioned reasons of commissions and higher expenses primarily, but also because they can't see the future any better than you can, Rita. So no, we would be advocating using the passive, low-cost approach. Put the money in there and get away from your broker. Maybe keep your deposit there, but not your investments.
Here's what's really interesting, Rita. The American Balanced Fund, 5.75% commission going in, and then the annual fees are 0.58% per year. The Vanguard Balanced Index has 0 commission going in, and its annual fees are 0.18% per year, or about 40 basis points cheaper. And what's interesting is their 15-year performance is identical, and the Vanguard Fund provides a higher level of much higher level of diversification. I don't mean just a little. I'm talking a lot, because we're talking about the Vanguard Balanced Index has 3,645 bonds or 3,645 stocks and 12,000 bonds, whereas the American fund has just in the hundreds.
They're making a bet, and that's what we would expect them to do.
Does that help? We hope.
So how do I move money? I mean, do I,
Easy.
because I have an appointment with him on Monday, do I say, you know what, I don't want to be with U.S. Bank anymore? We each have like $50,000 in our Roths. We have a little over 100,000. And so he said the commission rate is going down to 3.75 because we have over 100,000.
Big deal. Still a commission that you don't need to pay for funds that are not as balanced or as stable. You're going to get greater stability. Always get greater stability,
and
with better
easy.
diversification. And so here's it's so easy.
All you're going to do is go to Vanguard.
I'm going to tell you, it's so easy.
Vanguard.com, set up a Roth IRA for each one of you. That's going to be simple. And then Vanguard is going to ask you, where is the money you want to move? They will help move the money out of the custody of U.S. Bank into their custody. You buy the one fund. I think it's a great solution, cheaper, and I would expect better performance over the long haul.
And the good news is you don't even have to talk to the broker about
Nope.
it. They'll do it for you, and it's done. Good luck.
Oh, okay. So do I buy Vanguard S&P 500?
No. If you're gonna be totally, we're going to act in a better fiduciary capacity. What I would suggest you and your husband both do is go to talkingrealmoney.com and take our risk quiz. Okay, it's free. Take that. Figure out what your comfort level is for volatility. Then you can consider at Vanguard going one of two ways. You can go with the Vanguard Balanced Index, which is 60-40, or you can pick a Vanguard Target Date Fund. The Target Date 2020, 2025, 2030, 2035, one of those. Low fees, and you're going to get the right diversification for your risk tolerance. So take the risk quiz, then go to Vanguard, open the accounts, and then have the money transferred in kind over, and then they'll convert it into the Vanguard funds. Simple. Okay. All right. Thank you for the call. We appreciate it. And real quickly, Ken, you're up next. Welcome to the show.
Hi, how are you?
Good, thanks, Ken. What you got for us? We only have about a minute.
Hey, I got a really short question, so that's good. Hey, you're talking about Vanguards and stuff. I had an account in an investment group in Portland, and then 9/11 came by, and they were using blocking tactics to keep all of our money in their business. And then in 6 days, I lost $30,000. Is there anything that I can do to try to get this money back? Or?
Well, you can get it back. You need to go to another broker and have them transfer it in.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Okay, now that I've thought about it, I think what he was saying is not how can I get it out? It's not still there, but how can I get back the $30,000 I lost? And Ken, I'm sorry. A couple of things are against you. One, there's no attorney that'll take it. It's too small. Two, you'd have to go to arbitration. And three, it's probably past the statute of limitations. Chalk it up to experience. I'm really sorry. If you, though, have a complex question, you have something that really requires some research, you want to get the right portfolio, you want to get started on a plan for retirement, you want a little help doing that from a real live fiduciary advisor planner, we'll give you that for free. We give it away all the time. We do. We give it away all the time because we found it's actually a good business model. It works, it builds business, and we don't ever have to ask you or put any high-pressure sales pitch on you. You just go to Vestory.com and set up an appointment. Set up an appointment right there on the homepage, Vestory.com, Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. And to keep the lawyers happy.